Imagine early 20th century America, a nation exploding with industrial power, innovation, and ambition. Cities grew exponentially, factories roared, and fortunes were made overnight. This era of unchecked capitalism, however, had a dangerous underbelly. America's financial system was a Wild West, fragmented and unregulated, prone to sudden crashes. There was no central authority, no safety net. It was a high-stakes game where individual players held immense, often precarious, power over the entire economy. At the heart of this volatile system were the trust companies. Unlike traditional banks, these institutions operated with far fewer restrictions. They could pay higher interest rates on deposits, attracting vast sums of money from the public. But they also invested aggressively, often in speculative ventures and risky stock market plays. They were the fast-growing, glamorous new kids on the financial block, promising quick returns, but carrying hidden dangers that few understood or even cared to acknowledge. This lax regulation fueled a feverish climate of speculation. Everyone, it seemed, wanted a piece of the action. Investors borrowed heavily, often from these very trust companies, to buy stocks and gamble on industrial enterprises. The market was booming, creating a widespread, almost giddy belief that the good times would never end. But underneath the glittering facade, cracks were starting to form in the foundations of this rapidly expanding financial house of cards. Enter the key players, F. Augustus Heinze and Charles W. Morse. Heinze, a flamboyant Montana copper baron, and Morse, a shrewd New England financier, were quintessential Gilded Age speculators. They built vast, interconnected financial empires of banks and trust companies, often leveraging their holdings to manipulate markets. Their ambition was enormous, their methods audacious, and their intertwined network of institutions would soon become the unexpected flashpoint for an economic earthquake. In October 1907, Heinze and Morse launched an audacious scheme to corner the market on United Copper Company stock. Their plan was simple: buy up enough shares to control the supply, then force other investors who had short-sold to buy back shares at inflated prices to cover their bets. It was a classic Wall Street maneuver designed to extract massive profits from their rivals and solidify their dominance in the copper industry.
But the copper corner attempt quickly unraveled. Heinze miscalculated the number of available shares and the resolve of his opponents. When he tried to execute the squeeze, too many shares appeared on the market, flooding it. The price plummeted, devastating his investment pool. This colossal failure wasn't just Heinze's problem. It immediately impacted his web of financial institutions, specifically the Mercantile National Bank, where his losses suddenly became the bank's deep liabilities. The direct fallout from the copper corner crash quickly hit the Mercantile National Bank. Depositors, hearing whispers of Heinze's massive losses and the bank's exposure, began to withdraw their money. This loss of confidence was infectious. Financial institutions in that era were deeply interconnected. A problem at one, especially one tied to a prominent, controversial speculator, quickly sent shivers through the entire system, raising questions about the stability of others linked to Heinze. The dominoes began to fall. Heinze was closely associated with the Knickerbocker Trust Company, one of New York's largest and most respected trust companies. Though Knickerbocker wasn't directly involved in the copper scheme, Heinze's brother was its vice president, and the company had provided loans to Heinze's associates. The public, already skittish, drew immediate connections. If Heinze's personal empire was collapsing, how safe were the institutions he and his family touched? Whispers soon turned to outright fear. On Monday, October 21st, rumors about the Knickerbocker Trust's solvency spread like wildfire through downtown Manhattan. These weren't just idle rumors. They reflected a deeper anxiety about the unregulated nature of trust companies. People started questioning if Knickerbocker had been too aggressive, too exposed to risky investments. The air thickened with a nervous energy, a collective unease that foreshadowed a far greater financial storm brewing. Tuesday, October 22nd, 1907. A queue began to form outside the opulent marble facade of the Knickerbocker Trust headquarters on Fifth Avenue. It was small at first, then grew, hour by hour, into a sprawling line of anxious depositors desperate to retrieve their savings. This wasn't just a withdrawal, it was a classic bank run, a frantic rush fueled by fear that the company's vaults might soon be empty. The panic was now palpable. By the end of that fateful Tuesday, the Knickerbocker Trust Company, once a symbol of financial might, had collapsed. It had paid out $8 million in just 3 hours, exhausting its reserves. The doors closed, sealed by a lack of funds. The news sent a seismic shockwave through the financial world. The failure of such a prominent institution, one many believed too big to fail, confirmed the public's worst fears. No one was truly safe. The contagion spread rapidly. The collapse of Knickerbocker Trust triggered runs on other major trust companies and banks across New York City. Depositors, fearing their own institutions would be next, rushed to withdraw their funds. The financial district descended into chaos. The money market, the circulatory system of the economy, seized up. Banks stopped lending to each other, unsure who would be the next to fall. Trust vanished, replaced by an overwhelming tide of fear. Wall Street became a scene of unprecedented turmoil. Stock prices plummeted as investors, desperate for cash, dumped their holdings. The New York Stock Exchange teetered on the brink of closure, threatening to compound the panic into a full-blown economic depression. Businesses couldn't access credit, threatening bankruptcies and layoffs. The entire American financial system, built on a foundation of confidence, was now facing total collapse, with no clear savior in sight. That savior, as it turned out, was J.P. Morgan. The 70-year-old titan of finance, vacationing in Richmond, Virginia, rushed back to New York. Morgan was already a legendary figure, known for his vast wealth, his intimidating presence, and his track record of single-handedly stabilizing markets during previous crises. He was not merely a banker. He was, in essence, America's unofficial central bank, its last resort, a powerful force of order in a world descending into chaos. Morgan immediately took command. He convened an emergency meeting of the city's leading bankers and financiers at his magnificent library on 36th Street. This was not a plea for help. It was a demand for cooperation. With an imperious gaze and unyielding will, Morgan made it clear that a unified, coordinated effort was the only way to avert catastrophe. He expected them to set aside rivalries and work together under his formidable leadership.
Morgan's first step was to demand absolute transparency. He sent his trusted lieutenants, including Benjamin Strong and George Perkins, to scrutinize the books of every embattled trust company and bank. He needed to know precisely who was truly solvent and who was beyond saving. His stern directive was clear: no hiding of assets, no downplaying of liabilities. Only with complete, honest information could he formulate a plan to inject liquidity and restore some semblance of order. The situation with the trust companies was dire. Morgan decided to save only the strongest ones, those whose collapse would cause catastrophic wider damage. He assembled a consortium of banks, compelling them to pool their resources and provide liquidity to these struggling but salvageable institutions. It was a brutal form of triage, requiring immense political and financial leverage, but it was effective in preventing further dominoes from falling within the trust sector. Just when it seemed the trust company crisis was under control, another immediate threat emerged: the New York Stock Exchange. Brokers, unable to secure short-term loans from panicked banks, faced imminent collapse. Without these loans, the stock market would have to close, a symbolic and practical disaster that would have solidified the panic. The exchange's president, Frank Sturgis, rushed to Morgan's library late one evening, pleading for a solution before morning. In an extraordinary all-night session, Morgan locked the city's bankers in his library, refusing to let them leave until they agreed to an 18-hour commitment. He demanded they collectively pledge $25 million to keep the stock exchange open and operating the next day. The tension was immense, but under Morgan's unwavering glare, they eventually capitulated. This massive infusion of liquidity saved the exchange, preventing a complete financial meltdown on Wall Street. The crisis was far from over. The economy was still teetering, and a major industrial firm, the Tennessee Coal, Iron and Railroad Company, was on the brink of collapse.
TC&R was heavily indebted, and its failure would devastate numerous banks and brokers holding its shares as collateral. This wasn't just a financial problem, it threatened the real economy, potentially triggering widespread industrial bankruptcies and unemployment, pushing the entire nation into a deep depression.
Morgan saw an opportunity for a dramatic solution. He orchestrated a deal for U.S. Steel, a company he himself had created 6 years earlier, to acquire TC&R. This merger would stabilize TC&R, preventing its collapse and the subsequent ripple effect through the banking system. It was a bold move, but it presented a unique legal challenge, as the acquisition would create an even larger steel monopoly, flying in the face of existing antitrust laws. To complete the TC&R acquisition, Morgan needed an unprecedented waiver from President Theodore Roosevelt, who was famously anti-monopoly. Morgan dispatched Henry Clay Frick and Albert Gary, U.S. Steel executives, to Washington, D.C. They met with Roosevelt late into the night. Faced with the stark reality of a national economic collapse, Roosevelt, despite his antitrust convictions, gave his personal approval. This demonstrated the sheer gravity of the crisis and Morgan's unparalleled influence. With the New York Stock Exchange stabilized and the TC&R deal averting an industrial catastrophe, the worst of the panic began to subside. Morgan's decisive leadership and the forced cooperation of the banking community slowly restored public confidence. The runs on banks and trust companies gradually stopped. The financial storm that threatened to engulf the nation was calming, thanks to the sheer force of will and immense personal capital of one man. While Morgan's actions saved the country from immediate disaster, the Panic of 1907 exposed a critical flaw in America's financial architecture: the lack of a central bank. The nation's entire economy had relied on the impromptu actions of a private citizen. It was an unsustainable, dangerous system. The urgent need for a more stable, regulated, and resilient financial framework became undeniably clear to everyone, from bankers to politicians. The painful lessons of the Panic of 1907 directly paved the way for landmark financial reform. Just 6 years later, in 1913, Congress passed the Federal Reserve Act, establishing the Federal Reserve System. This new central banking system was designed to provide stability, manage the money supply, and act as a lender of last resort, ensuring that America would never again have to rely on a single individual to rescue its entire economy.